Okay, first topic under the discounted cash flow method. It is about forecasting a financial state. Forecasting the financial states. Actually, for your exams, you don't need to forecast the financial statements, okay? Because your examiner definitely will do the forecasted financial statements, okay? But you should have some basic idea about the main things or the main facts relevant for the forecasting of financial statements, okay? Because forecasted financial statement we can say as our main input for our pre-cash flow valuation method, because pre-cash flow valuations method we depend on what? We depend on the future pre-cash flows. No, we depend on the future pre-cash flows. Future. It is not about the current data, or it is not about the historical data. We should have future data to identify the free cash flow valuation method, or we should have some forecasted data to calculate the entity free cash flow. Okay, then for that purpose, definitely we should forecast our company financial statements, company financial statements, including profit and loss statement. We should forecast our P&L, then we should forecast our balance sheet as well as our cash flow statement. We should forecast this statement. Then based on this forecasted financial statement, we can calculate the free cash flow. Okay, then as I told you, please keep in mind, you don't need to forecast the financial statement for your examination purpose. Definitely your examiner will give forecasted financial statements, but some of the cases I identify when I analyze the past papers, your examiner gave forecasted financial statement, but you have to do some adjustment to these forecasted financial statement, because then I'll explain briefly a procedure that we use for the forecast financial statement. Okay, then practical scenario, we forecast our financial statements. We started from our P&L. Okay, then as I told you, I have created hypothetical. This is a hypothetical company. Okay, then let's name this as ABC PLC. Okay, then this is for the ABC PLC. Okay, then ABC PLC. Then their latest year ended 31st March 2024. Let's assume it as the latest financial year historical period is 31st March 2024. Then we have details for the last 7 years from 2018 to 2024. Then based on the historical data, here you can see we have forecasted P&L, forecasted profit and loss for the from financial year 2025 to financial year 2030. Then you can see we forecasted revenue, cost of sales, gross profit. Then for the fair value gain on investment property, here we here we didn't forecast this fair value gain on investment properties. There is reason for that. Okay, but this point I don't have to explain this one. Then for other income, selling and distribution, administration, all of those in be forecasted. Okay, but main thing that you need to keep in mind, we need to forecast all of these details based on what we need to consider about the company future plan. Okay, then in our past behavior and industry forecasted data and country economic condition and management expectation, we need to consider about all of those things. Okay, then as our preference, we can't forecast the company financial statement. Okay, then as an analyst, I am responsible for forecast my client financial statement. Then when I forecast my client financial statement, I can't do it based on my preference. Okay, or as my thinking pattern. I should incorporate their past behavior, their industry forecasted data and industry specific things, then country economic condition, because most important thing is we can't go beyond the country economic condition. Then for example, then for the Sri Lankan context, I hope for those who don't live in Sri Lanka, they know about the IMF conditions. Okay, then as per the IMF conditions, it it was affected for these conditions were affected for the many industries. Then I recently completed valuation for one of the major finance company in Sri Lanka. Then when I performed the valuation for that finance company, I had to focus their uh, earning assets. I had to focus their earning assets. Then when I forecasted their earning assets, I forecasted it based on the Sri Lankan private debt market. Sri Lankan private debt market and that company market shares, because as per the IMF conditions, I think there is condition that they specifically highlighted that Sri Lankan private debt market cannot go beyond 50% from their GDP. That means GDP to private debt market ratio should be approximately 50%. 50%. It can't go beyond the 50%. Therefore, when I forecast the company earning assets, I need to incorporate that thing into the my forecasted financial statement, because I can't go beyond the economic conditions. Okay. Therefore, economic condition is the most important factor when we forecast the financial statement. Other things, the management expectations, because then let's assume, then if I then based on the my analysis, if I forecast the earning assets as 100 million, but management said no, they can't go 100 million. Their forecast is 90 million. Then in this case, I need to go with their forecast in details if it is more rational, because management of the company, they know about their company, no, because as an analyst, I try to analyze their company from different perspective. But as the internal persons, that management, they know about their company. Therefore, I can't argue against their things. If they have rational, okay, then if they have reasonable rational for their forecasted details, definitely I should go with that rather than the my analysis. Okay, whatever things, then I need to incorporate all of those things into my forecasted financial statements. Okay, but for your exams, you don't need to forecast your financial statements. Your examiner will give the forecasted financial statements. Okay, then but as I told you, some of the situation you examiner asked to do some adjustment to the forecasted financial statements. Okay. Then one thing is, when we forecast our financial statement, we need to remove one-time expenses. So there can be some one-time income or the one-time expenses. Then we need to remove these from our financial statements, and we should forecast our financial statement based on the our cooperating activity. Then, for example, then let's assume then under their administration expense, or let's assume under their other income, let's assume in financial year 2023, then their total other income is how much? In financial year 2023, other income is 51,954. Then let's assume this 51,954, it is included with insurance claim. Insurance claim received 10,000. If it is included, insurance claim received 10,000, can we consider this insurance claim as our regular other income? No, it is one-time income, no? Because each year we can't expect some insurance claim, no, then insurance claim we will receive based on the some unexpected situation, or the unexpected accidents, or the whatever the things. Then insurance claim, we can't say it as our regular income. Therefore, we can say insurance claim as our one-time income. We can say it as our one-time income. If it is one-time income, then when we forecast the financial statement for the future forecasted period, we need to eliminate this 10,000. We need to eliminate this 10,000 from other income, and that means simply we need to remove this from our other income, and based on the balance 41,000, then we can forecast our financial statements. Okay. Then like this, we need to eliminate a one-time income as well as one-time expense. Then let's assume like that situation. Then our administration expense for financial year 2024, let's assume this 14,000, it is included with like that employee compensation. Okay. Then let us assume it is included with some employee compensation. Okay, then let's assume some of the employee during their work time they uh, during their work time, let us assume that employee faces some accident and that employee got injured. And if that situation, since that employee injured, that employee went to the court and filed a case against us, and we had to pay some employee compensation. And like that situation, this employee compensation, can we say it as our recurring expense? No, it is not recurring expense. No, then we can say it as our one-time expense. Then when we forecast our future financial statement, we need to eliminate that employee compensation, and without considering this employee compensation, we need to forecast our future uh, administration expense. Okay, like that. If we have like these one-time expenses, we need to eliminate these one-time expenses or one-time income from our financial statement. And without considering those one-time expenses or income, we should forecast our financial statement. Okay, we should forecast our financial statement. Actually, for examination purpose, that's the main thing that you need to keep in your mind, because some of the situation your examiner can ask to adjust like those things. Okay, therefore, please keep in your mind. When we forecast our financial statement for the valuation purpose, we need to eliminate one-time expenses and the one-time income from our historical data, because we forecast, then you can see, then here, then we up to 2023 we have historical data. Then we forecasted this 2024, 5, 6, 7, 8. These financial years based on the 2023 and other historical data. Okay. Then there is some rationale, as I told you. We forecasted these things based on some basis. Okay. Then we have some rationale to forecast those things. That's the thing. Actually, it's a practical thing. Okay. Then actually for your examination purpose, you don't need to understand the practical thing relevant for the forecast and financial statement. That's the main thing that you need to keep in your mind. We forecasted financial statement based on the considering few factors. One thing is the past behavior, other thing is the industry forecasted data, and economic condition and the management expectation. Based on those factors, we can forecast the financial statements. And one thing that you need to keep in your mind, when we forecast our financial statement, we should eliminate one-time expense or the one-time income. Okay, then that is about the forecasting financial statement. For your examination purpose, you don't need to forecast the financial statement. Your examiner will give forecasted financial statements. Then we can move on to our second topic. It's about the estimating the free cash flow. That's the most important. Okay, then based on the forecasted financial statement, we need to estimate the company free cash flow. Then let's see how can we estimate the company free cash flow, because as I told you, the under the free cash flow valuation method, our main value driven practice is our free cash flow. Then therefore, for the forecasted period or for the future period, we should identify the company's free cash flow. Then let's see, based on the forecasted financial statement, how can we derive the company free cash flows.